Good morning. Welcome to the Horizon Advisors Quarterly Review. It is the end of Q1. I'm Jay Shook. This is Brad Spindler. It is tax season for those who celebrate. I will be celebrating by writing a check to the United States' largest employer.
Who's that, Jay? Costco?
It is not, Brad. I will be writing a check to the U.S. government to pay my tax bill. And I will celebrate that by using the goods and services that I hope they provide to me.
They're great ones.
Yes. So, Brad, outside of tax season, what's going on in Q1?
Whew, glad you asked. It's been an eventful Q1 for those of you that watch the news or follow the markets. There's been a lot of volatility. With that, the U.S. stock market, depending on what index you look at, is down anywhere from 5 to 10%. However, international stocks are having a great year. Finally. And they're up between 5 and 10%, so quite the opposite of the U.S., depending on what index you look at. And bonds are proving to be a hedge once again. They're up anywhere from 2 to 3% if you have some decent bonds. So, Jay, now that you know what the market has done this year, how do stock market valuations look?
Yeah, if we're going to focus on the domestic market or the S&P 500, which is really just sort of a broad index covering the United States, things still are not cheap. They've come down. They're cheaper than they were. At least in my opinion, they're not cheap. You know, if we look at the PE ratio, the forward PE ratio, which is really the company's price relative to their expected earnings over the next year, right now they're trading at about 20 times earnings. That 30-year average on that sits around 17. So, again, a bit expensive if we're comparing it to an average. Again, one of the big other ratios that I like is the CAPE ratio.
What's the CAPE ratio, Jay?
Glad you asked. The CAPE ratio is very similar to the PE ratio in that we're looking at the company's earnings, but over the previous 10 years, the average, and in what that company trades at relative to their average earnings, inflation adjusted. So today we're sitting around 35. If we want to go back to our 30-year average as a point of reference, that sits at about 28 times earnings. So again, not cheap. We are definitely cheaper than we were. There's no question. We've come down a bit. Depending when you're watching this video, we're a lot better than where we were to start the year. And today we're sitting at a place that is similar to where we were as far as valuations go at the beginning of 2022. However, there's another element that a lot of advisors or money managers will take a look at. That is the potential risk-free rate of return, which is what you could earn if you invest into an asset that's considered to be little to no risk.
What do you assume is the risk-free rate, Jay?
So I'm going to use the 10-year Treasury. Some people may say that's not risk-free, and really, truly, nothing is risk-free. But that right now is trading somewhere between 4.2 and 4.3%. Going into 2022, when we again had similar market valuations, we actually were only around 1.5% on that risk-free rate of return. So what does that mean? That means that somebody who doesn't really want to take on risk but wants to make some money could actually make a lot more money today relative to 2022 by buying a 10-year Treasury. So, of course, hypothetically, that would incentivize some people to at least get out of the market and go more of the risk-free route. So with that being said, markets are expensive. We know valuations are high. What do we do?
Great question. It is a very different rate environment now today, so thank you for touching on that. There's a lot of volatility in the markets, and that's new for some investors because 2023 and 2024, there was very little volatility. Markets just continued to go up day after day after day. However, this year we've seen a correction, which a correction is a 10% pullback, and those happen often. They happen in between every 1 and 2 years, so it is a part of being an investor, Jay, handling corrections. And I'm going to break this down from 2 standpoints to your question of what do we do. So if you're younger, 20 to 50 to mid-50s, and you're still investing and saving for retirement and your goals, you should welcome volatility because you can get stocks at a cheaper price. When you're saving, you'll get stocks cheap. You'll get them fairly valued, and you'll get them expensive. When there's higher volatility, you have a better chance of buying them cheap. Now, if you're on the other side of the spectrum, you're older, you're retired, you're drawing from your portfolio. You should have, hopefully, a diversified portfolio. So not everything in your portfolio is down 5 to 10% like the U.S. stock market. If you own international, you're happy. If you own bonds, you're happy. But above all, you should check your emotions, stay invested, stick to your long-term plan, and don't panic and make any big changes because markets are down.
All right.
So, Jay, now that you know what I think about that, Where do you think markets go in the next 3 to 12 months?
I have no clue. And that is the actual fact. And I think any good advisor and most good money managers are going to give you a pretty similar answer when we're talking about short-term market moves. Long run is a different conversation, and we can get into that. But right here, right now, I mean, it's a safe bet to tell anybody to expect volatility. We're in a situation where there's, of course, lots of conversations around tariffs, if they'll be implemented and how long they'll be implemented. That creates uncertainty. Things are not clear in the stock market. And one thing we know is that markets like clarity. So for now, volatility is a good bet. Where these things actually settle is an unknown. The other big element today that we'll discuss is the fact that there's an expectation for negative GDP in Q1. That is, of course, not ideal. But the reasons surrounding that are also sort of unclear. We have negative consumer spending. It's shrunk. We've also seen more imports than exports. That doesn't help GDP. But also, there's the assumption that could just be a lot of companies trying to get ahead of the tariffs, trying to import what they need to before tariffs go into effect. So could it be short-lived? Could it be something that drags on? It's an unknown. But as we covered earlier, we're in a situation, markets are priced for good news. That means if we don't get it, you would expect a move down. If we do, however, get good news, whatever that may be, whether it's a not such a bad GDP number, maybe some of these tariffs and other political situations are settled, things could be a lot more positive. So all that being said, if the next question is am I going to get out of the market? What do you do, Brad?
You do not get out of the market. That is almost always the worst thing to do. So, for example, 2007 October was the peak of the S&P 500 for a point. We all know what happened next. Jay, if I invested $10,000 at the peak of 2007, you know what it'd be worth 5 years later?
So 10,000 in 07, 5 years later, you probably lost half, right?
You did not. You broke about even. You were up slightly. Now, it gets a lot better when you go to 10 years. So 10 years later, that same 10,000 would have been 20,000, which is about a 7% rate of return. And the one I like the most, what do you think that would be worth today, Jay?
I have no idea.
Over $50,000. So it's hard to time markets. Almost nobody can do it. And I don't think you can do it, I can do it, or anyone really that we know. So stay invested. And even if you invest at the peak, you'll still make money long term.
So you're telling me it was bad that I sold everything last week?
It's very bad, Jay.
Just kidding. Anyway, that's about it for Q1. I think that wraps it up. Stay the course, have a plan, and have a good Q2 from Horizon Advisors.